Hi everybody. In our previous video, we discussed the accounting for a bond issued at a discount. In this video, we'll discuss the accounting for a bond issued at a premium. When the stated or contract interest rate is greater than the market or effective interest rate, the bonds will be issued at a premium. Several things to remember about that. As we discussed in the previous video, the stated or contract interest rate is the rate specified in the bond indenture. It is the rate of interest that will be paid to the bondholders over the term of the loan. And the market or effective interest rate is equivalent to that interest that is being paid on bonds of similar risk and maturity. One way to look at it is this. If our bonds are paying more interest than potential investors could earn by buying someone else's bonds, our bonds are very attractive to investors and we can sell the bonds for more than the par value. An investor might pay $510,000 for a $500,000 bond, but at maturity, the bondholder and investor will be paid only the $500,000 par value. Keep in mind that the premium issue price is calculated to equalize the yield on bonds with a less attractive market rate of interest. Let's work another bond problem. At 6/30/X1, XYZ Company issued a 10% 3-year bond with a par value of $250,000 and semi-annual interest payments. On the issue date, the annual market rate for these bonds is only 6%, which implies a selling price of $110.84. As we've stated, when the contract interest rate is greater than the market rate, the bonds will be issued at a premium. Go ahead and calculate the amount of cash to be received upon issuance and write the journal entry to record the issuance of the bond. When you're finished, start the video again to check your answer. The cash received from the issuance of these bonds is $277,100. That's the par value of the bond, $250,000 times 110.84%. The journal entry to record the bond issuance, then, is debit cash, $277,100, credit bonds payable, again for the full par value of the bond, $250,000, and we need another credit to get this journal entry to balance. So credit premium on bonds payable, $27,100. Please keep in mind that a premium on bonds payable is an adjunct or an additional liability account. It attaches itself to bonds payable and has the same normal balance. Both of them have a credit balance. Let's prepare an effective interest amortization table for this bond. You've seen a table very similar to this in the prior video when we were issuing a bond at a discount. Cash interest is calculated the same. Interest expense will be calculated the same. The premium is a liability account. So the carrying value of this bond issued at a premium is the $250,000 par value plus the premium. As the premium balance goes down to ultimately zero, so too will the carrying value of the bond. Why don't you go ahead and complete this bond amortization schedule? You will have a rounding problem at the bottom. Go ahead and solve the rounding problem like we did in the last video. And when you're finished, check your work. The cash interest paid is the par value of the bond, $250,000, times 1/2 the contract interest rate, and this bond has a 10% contract interest rate, so half of that is 5%. While we're here, look at the market interest rate. That's 6% annual market interest rate. So $12,500 is the cash interest payment for 6 payments during the 6 semi-annual payments during the 3-year life of the bond. The interest expense is calculated as the prior year's carrying value, which is also known as amortized cost, which is also known as outstanding balance. So the prior period's carrying value times 1/2 of the market interest rate. For the December 31st X1 interest expense calculation, $277,100 was the prior carrying value or amortized cost, times 3%, which is 1/2 of the market interest rate, equals $8,313. Because the carrying value will change with every payment, then the interest rate will also change with every payment. The prior period's premium balance less the current period's, I went to the wrong one. The column C is the difference between the interest paid and the bond interest expense. Interest paid was $12,500 minus 8,313 equals 4,187 amortization of the premium. The premium balance then goes down every time period by the amount of the amortized premium. So $27,100 minus 4,187 equals 22,913. And the carrying value is going to increase each time because the carrying value is the bond's par value or face value plus the unamortized premium. And remember that the premium has a credit balance, and because it's an additional liability account, and so does the bond's payable account. So you have to add the two together. Two credits add together. So $250,000 plus 22,913 equals 272,913. And when you carry that calculation down, you ended up with a $17 amount here, which, if it's in the premium balance, which has a credit balance, you have to subtract that from the interest expense, because interest expense has a debit balance. So it originally calculated at $7,646 minus $17 equals bond interest expense in the last payment of $7,629. That makes the premium balance 0. And at the end of the bond's period, the carrying value, amortized cost, or outstanding balance of the bond is $250,000. So please use this amortization table and write the journal entry for the first semi-annual bond interest payment and the 5th semi-annual bond interest payment. When you're finished, start the video again to check your work. So the journal entries are debit interest expense for the first semi-annual bond interest payment of $8,313, debit premium on bonds payable $4,187, and credit cash $12,500. And those numbers came from right here. The journal entry for the 5th semi-annual bond interest payment is debit interest expense $7,787, debit premium on bonds payable $4,713, and credit cash $12,500. Well, that's all for this video. In our next video, we will use the present value tables to calculate the issue price of a bond. In these two examples, you were given an easy way to calculate the issue price without looking anything up on the present value tables. Frequently, you will not be given this information, and you will need to calculate the bond issue price. So I'll see you next time.